people, let's quickly revise cash flow statement with the help of our chart book. 1. Cash flow statement is simply a statement which captures cash coming in and cash going out. It doesn't capture only cash coming in, it captures cash and cash equivalent coming in, cash and cash equivalent going out. Cash for this purpose includes cash in hand as well as cash at bank. Cash equivalent means they are highly liquid investments which has a maturity of 3 months or lesser. It should be readily convertible into known amounts of cash, and it should have insignificant value change risk. Oh, that's one. And this particular cash flow statement treatment is covered by accounting standard 3. Okay, and this inflow and outflow of cash, we put it under 3 categories. Those 3 categories are operating, investing, and finance. And to find out operating cash flow, we have 2 methods, that is direct as well as indirect method. Under operating activity or under direct method, all the cash flow from operating activities like cash from debtors, cash paid to creditors, cash purchase, all the data will be directly either provided to you or they will give you some information using which we can prepare the ledger extracts and get them. Under indirect method, we use profit as a base to get operating cash flow. So one of the important aspects you need to keep in mind when it comes to indirect method is check what sort of profit is available to us in the question. Generally, we see either profit before tax or profit after tax or profit after all the adjustments. One among these 3 given to us in the question. So which profit you are choosing, based on that the adjustment will go on vary. That is one. Next, sir. Under indirect method, we'll have to do some adjustments. Since we're using profit as a base to get operating cash flow, straightforward profit only cannot be adopted as indirect operating cash flow. We'll have to do some adjustments. Suppose they give profit after all the adjustments. First, any non-cash expenditures we need to add back. Non-cash expenditures ka example could be depreciation, amortization, preliminary expense written off, deferred revenue expenditures written off, transferred to reserve, etc., etc. Or discount on issue of debentures. Shares cannot be issued at discount, so debentures can be issued at discount. So if you have all those, add back because they are all non-cash expenditure. In examination, you need not call out what it is. This is only for your reference. Similarly, if you have any non-operating expenditures like interest, loss on sale of PPE, loss on sale of investment, loss on sale of intangible assets, etc., etc., or premium on redemption of preference shares or debentures, or premium on buyback of equity shares, if at all it is transferred to P&L. So such adjustments also are non-operating in nature, hence you add back. If you have any non-operating income like interest received, dividend received, profit on sale of PPE, investment or intangible asset, or discount on redemption of debentures, if at all it is transferred to P&L. So those sort of non-operating income, if you have anything, reduce it. Then we have to consider working capital changes. One, increase in current assets means minus, decrease in current assets means plus. Increase in current liability means plus, decrease in current liability means minus. Or if they directly give you working capital, increase in working capital means minus, decrease in working capital means plus. Okay. This will give you cash flow from ordinary activities. If there is any extraordinary activities, if there is any extraordinary items like insurance claim received, you have to show it separately at the fag end. Okay. In fact, tax paid also should be considered. And after that, you'll get the ordinary activities. Then consider extraordinary activity. Then you'll get the total operating cash flow, which will get reflected. This is one. The next one is provision for depreciation. Depreciation can be accounted under one of the 2 methods. One is the charge method. Another one is provision for depreciation. Provision for depreciation is also known as accumulated depreciation. If provision for depreciation account is maintained, then fixed asset ledger will always be shown at original cost because all the depreciation goes off to provision for depreciation account. That is one. And how long you need to maintain this provision? As long as the asset is there, provision for depreciation needs to be maintained. If the asset is derecognized, meaning if it is sold off or written off, then provision for depreciation relating to that asset can be closed. And the closure journal entry will be provision for depreciation account debit to PPE account. Okay, that is one. And provision for depreciation format I've given. Normally we prepare provision for depreciation format or ledger accounts to get depreciation as the balancing figure. Okay, provision. Since the journal entry to create provision is P&L account debit to provision, provision will have a credit balance. So its opening balance will come on the credit side, closing balance on the debit side. So the journal entry to create provision is depreciation account debit to provision for depreciation. This is nothing but the depreciation goes off to P&L. So to get this generally as a balancing figure, you prepare this particular ledger. And if any provision, if any asset is sold, that provision is not required. So the journal entry will be provision for depreciation to PP. That also will be captured over here. This is just for your quick reference I've given. All right. Then some other component is the dividend. With respect to dividend and provision for tax, we have one shortcut saying if only opening balance and closing balance, if it is given to us in the question, no other data, if only opening balance and closing balance is given, then we assume that the opening balance is paid out in the, since opening balance relates to last year, we assume that has been paid out in the current year. Okay. This particular assumption is made both for provision for taxation as well as dividend wala adjustment. And I've just brought the dividend ka for ledger format over here. Dividend is also our provision for taxation. Both are liability. Liability ka opening balance on the credit side, closing balance on the debit side. When you declare the dividend, the journal entry is P&L account debit to dividend account. So the posting will be by P&L. When you pay, the journal entry will be dividend payable account debit to bank. So this. So one among these, either this to bank or by P&L, one of them will be arrived as a balancing figure. Same goes for provision for taxation also. Okay, then provision for taxation ka format also I brought in over here for your quick reference as such. Then few other points you need to remember is if any adjustments like bad debts, discount, etc. is given under indirect method, will you consider or will you just ignore them? Will you ignore them because it has already gone to P&L? It's already considered. Again, if you try to consider them again, your cash flow statement will not match. So simply ignore them under indirect method. And do not forget the interest component. Interest, provision for tax and all, generally people miss out. So interest on debentures, loan and all should be from operating activity you should add, and from a financing activity you should minus, because this will not be given specifically in the adjustment. They'll simply say 10% loan, 12% debentures, etc. etc. So be aware of this particular adjustment. Okay. So that's all as a quick revision with respect to cash flow statement. Thank you.